Good morning, everybody, and welcome back to Beat the Bell, presented by Kane Capital. We're ready to go. It's Friday. Hope that everybody's had a phenomenal trading week up to this point. Yesterday, we saw quite the rally, 60-point move higher in SPX. What do we have in store today to talk about it? We've got an awesome panel with us, starting with Money Mander. Money Mander, good morning.
Good morning. Happy Friday. Hell of a rally we saw yesterday, and we got some big data and earnings this morning we'll cover.
All right, Diamond Trades.
What's going on, guys? Definitely have some data to cover from the last time that we came on here. Let's wrap up the week strong.
Attaboy. All right, and last but not least, Moe Mamba.
Good morning, Hondo boys. Good morning. Good week. One loser, 5-6 winners. So let's look to end the week strong.
Crushing it, Mo. All right, let's go straight into Fed forecast and economic calendar.
Yo, let's do it. So we can go ahead and start with the economic calendar for today. We had retail sales, which just came out. Retail sales came in at minus 1% versus minus 0.4% expected. So a much steeper drop in retail sales than we had expected or forecasted for this quarter. We also have a Fed speaker in about 8 minutes here. And then at 10 o'clock, we have the Michigan consumer sentiment number. That number is going to be preliminary. So that's not the final read, but that's the first number that we get for April. We had PPI yesterday. So let's go ahead and jump over to that. Yesterday, the market recovered basically all of its losses from that CPI number on Wednesday. So we initially sold off about 1%, a little bit more on that CPI number. And the market, immediately rebounded and recovered all of its losses and then some yesterday on the back, and partly on the back of a lighter than expected PPI number. So the producer price index yesterday came in seriously light at about minus 0.5% month over month versus basically minus 0% month over month. So analysts were sort of expecting a flat print, expecting no change more or less in the month over month PPI. The month over month actually dropped pretty substantially. Showing that producer prices have come down, and that's really starting to bolster people's feelings that, okay, this battle with inflation is really nearing the end, and has people thinking that, okay, May could be the last time that the Fed wants to hike rates before pausing that rate hikes, just to really start to see the cumulative effect of what they've done. That's really what the markets are hoping that this data means, right? As we continue to get more confirmation that inflation is really starting to roll over here into the summer, I think that this PPI print is a big part in that. And then we see retail sales again this morning coming in light. So a couple of light data points, even with CPI that we got on Wednesday, right, came in basically flat at about 5% versus that 5.2% expectation. So we're starting to see a situation where a lot of this inflation data is coming in very tame and has people thinking, even in the back of your minds, right, even though we've seen the bank situation, the bank crisis start to get better. I think in the back of people's mind, that is still very fresh, and people are thinking, okay, well, if inflation is coming down, how aggressive does the Fed really want to be, and how much stress do they really want to put on the financial system? Thinking, okay, we'll probably pause. Even if that, a lot of people are calling for basically no hike at the May meeting. We're going to have to see how that one plays out. But another note, producer prices are actually down 2.3% on a year-over-year basis versus up 4.9% in February. So 2.9% in March versus 4.9% year-over-year change in February, a really drastic drop, just to sort of put that into perspective, showing exactly how much producer prices fell, and exactly how much of a positive tailwind that could sort of be on this battle against inflation. Mander, what are you thinking?
Yeah, 100%. I think we're definitely getting to that point where inflation is cooling. And so now moving forward, I think the battle is going to be, can the Fed then get inflation to cool down without destroying consumer demand completely and putting us into that recession? I think we're getting to that point where that is like the two sides of your balance here. Can we get inflation down without destroying the economy? And that's what Jamie Dimon just talked about this morning. So let's talk big banks. Big banks had their earnings this morning. Massive squeeze on going pre-market right now. JP Morgan's up over 5% right now. Posted record revenues, massive double beat with EPS at $4.10 versus $3.41 expected. So a 20% beat over expectations, up 56% year over year. for JP Morgan. Wells Fargo, another big beat this morning. EPS in line, revenues with a 3% beat and up 20% year over year. So Jamie Dimon made some notes this morning. Clearly, I think everyone was thinking like in 2008, we saw this massive bank run on the regionals that had massive downside for the smaller ones, but massive upside for the big boys here, obviously with huge inflows. But Jamie Dimon made the note this morning that this crisis is distinct from 2008 in that it has involved far fewer financial players and far fewer issues that need to be resolved. But financial conditions will likely tighten as lenders become more conservative, and we do not know if this will slow consumer spending. And so to his point and to Jerome Powell's point there, this is kind of what Powell was talking about at the last meeting, right? They said the Fed might not have to take rates to where as high as they originally thought if the SVG, the Signature, all these bank situations caused lending conditions to tighten organically as banks became more risk adverse in the face of the looming recession. I think that is kind of the point we're at, right? Just same thing we were just talking with inflation. If lending conditions tighten on their own, if inflation starts coming down because of that and consumers are spending less, inflation is not really the worry. The Fed can definitely lighten up on policy hikes. I think then it gets to the point, does the financial conditions being so tight cause consumer spending to go down so dramatically that then we get into an earnings and a GDP recessionary environment. And to that point, right, we just saw retail sales come down. They doubled the contraction expected month over month. And commercial and industrial loan conditions are now the tightest they've seen since pandemic and then 2008 and 2009. So we're getting to that point in lending conditions here where they're getting very, very tight, especially after the bank run we saw. Now I think we just see how does that play out for the months and quarters moving forward with consumers wanting to spend less as financial conditions are so tight.
How tight lending conditions are, just look at the yield curve, right? You borrow on the short end and you lend on the long end. If you're going to borrow at such high rates and then you're not getting it back on the short end, that spread is no longer profitable for you. Why would a bank continue to shoot themselves in the foot? I've read something over the weekend where, when you have an inverted yield curve, it doesn't necessarily mean that the banks are just going to stop completely lending and it's going to be like a cold turkey thing. It just happens like that. Like they can survive some of that, but when you have extended inversion of the yield curve, it's been extended for so long, the inversion is extremely deep, right? So the spread is actually not even close. It's an extremely deep inversion. That's where you get like you were talking about that risk adverse sort of appetite from banks, and they're just not quite as ready to go out and give out loans. And that's exactly what Powell wanted to do, right? So I think that's exactly what we have been seeing. And the last thing I wanted to hit on before we get out of here is that the minutes release also came out on Wednesday, and they finally said the word in the minutes release. They were talking about a recession. Usually the Fed does not say the word recession because when they say it, it happens. And they finally let it go on Wednesday, and it came out in the minutes release. Any thoughts there?
It had to happen eventually, right? They couldn't just keep saying it's not going to happen. I think we're at that point where if you don't at least attribute and acknowledge that a mild recession is likely in our faces here, you're losing all credibility you have. So they're in a tough spot, but they did finally drop it. And so we'll see. Markets didn't really care. So we'll see how that goes moving forward, at least for stocks.
Yep. All right. That'll do it for us at Fed Forecast. We'll pass it back to Alejandro.
All right, guys, let's talk about the system. So yesterday, what did we see? Down here, remember, looking at the 1 hour 50 SMA. Up here, we have the 30-minute chart, SPX. Okay. So coming into yesterday, we got the sell-off into the close on what was Wednesday afternoon. All right. So Wednesday afternoon, the market sells off. Sentiment starts to shift. And rightfully so, in my opinion, because what we saw was for the first time in 2 weeks, we broke below the 50 SMA on the 1 hour SPX chart. So traded above it, serving as support all the way on this ride up, 200-point move in SPX. And then we finally broke below, and we were breaking below the 50 SMA on the 30-minute chart. So that kind of caught my attention because I started to tell myself, this looks like the first real attempt by the bears to gain control, and there's potential for us to make a leg lower. But there was something very, very important to be aware of going into Thursday morning, and that was PPI. A lot of people forget about PPI. We still had data to be released. We're not sure what the market wants to do. Whenever it learns something new, PPI was released, the market traded higher. That set off the rally. Sure, it was, obviously a short squeeze. And there's really no telling how aggressive these rallies can be. But what it did do was it caused SPX to reclaim the 50th SMA on the 1-hour chart, which is, of course, a bullish signal. On the 30-minute as well, we reclaimed. And so as soon as that happens, I told myself, bulls back in control. And as you guys can see here, and as I already mentioned, we saw a really strong squeeze yesterday. And later on in the show, I'm going to be talking about how I traded this move yesterday, exactly what I was looking for, and I'll be talking about my thought process. But before I do that, we're going to wrap up the system, and we're going to go to Moe for Mamba market analysis. Moe for Mamba market analysis. Maybe one day.
Go ahead here and share my screen. It's massive, massive. They were just infamous trend line right here. All right. Good morning. Good morning. Let's see what we got. So finally, the time has come. We're up in this 413, 414 range. We've tested it. Today will be the day where Mamba goes short. More than likely, we finally came up and tested it. Just depends on how we close. I have to watch the close. I don't want to trigger this early, and then end of day, we end up closing above. Sorry, give me 1 second. Let me just close out these EMAs. There we go. Okay. All right. So not the cleanest, right? HNS. We're up here. We did test this area, this 413, 414. Now the big level I'll be watching for today is 412.20 right there. 412.20. That's a really good support from our recent price action. That'll be a really good daily level. If we're able to sell back off and close below that, I do expect us to fall through into the zone. I will trigger my short if we look to close below this 411.8. 411.8. All right, 411.8. That's the level I'll be looking out for today. If we do come down, if we do continue to sell off here as we are pre-market. So intra-market, I'll watch that level. That's key. And then on my daily as well. So if we close, I expect to fall through back here. Now, if we do come down and test this as support and then bounce, I do expect this to come back up here and test this 414.5. Therefore, I won't trigger my short. I am going to have to respect what the price action is telling me, and that's a break, hook, and go through our daily resistance, right? We form some daily resistance. That's going to be a nice break, hook, and go. What that is for some of you guys that don't know, should know by now, but anyone new coming in and watching this, but a break through resistance, come back down, confirm as support, and then come back up and test your next level of resistance or breakthrough, right? So really being patient here. I'm close to triggering it. Just, give me one more day or 2 more days, and then we'll go ahead and trigger the sucker. But we're still able to swing some tickers. This is just on the indices for further out expiration. Otherwise, we've been smashing swing market. I've been able to swing large caps, mid caps. So it's not the fact that I'm just waiting on this to start taking some positions. No, there's other tickers out there with good price action, with good setups that we've been nailing this month so far. So it's been a great month. Last month, I mean, the start of the year, it's just been great. This year, when it comes to swings, you just have to be patient for that price action. But in regards to the indices and further our expiration, timing this short, trying to get the ultimate short, just got to be patient. Maybe one more day, but we'll see.
Patience. Yeah, Mo, you mentioned it. You have been swinging really well. So good to see that. Before we wrap up today's show, guys, we're going to do trade of the week.
It's time for America's Trade of the Week.
Now, here's a guy who knows how to trade stocks.
All right. So I mentioned it earlier. the long trade I took yesterday. So we were looking at the 1 hour 50 SMA, and that was a pretty good giveaway that we were going to start to trade higher. But I want to talk about the thought process and the plan. So from the plan I had written the night before, I wrote that I'd be interested in trying longs again over 41.32 for a move up to 41.45. And that's exactly what we got early in the morning. On the break over 41.32, I got long 41.34. I had also written in my notes that I wanted to see the reclaim of the 50 SMA on the 1 hour SPX chart, which we talked about earlier. So check there. And then the last thing that I needed for conviction was for Rocket Scooter to be in my favor. So Ryan, if you want to put up the next chart, please. So yesterday, the setup on Rocket Scooter, BLU, that's a bull long up for anybody who's not familiar. And what we can expect in a situation like this is for that 409 hedge pressure, that blue line, that you guys see there at the bottom, to work as support. We want the bottom of the bull zone to work as support as long as resilience is positive, which is what we saw, and as long as DD is greater than 0.5, which is also what we saw. So this was a textbook bull setup. And so this, along with the reclaim of the 1 hour 50 SMA, along with the breakout of 41.32, which was a key level of resistance going into the day. If you look left on the chart, I'd start with the 15-minute time frame. You could go all the way out to the hourly and just look left, see how prices react around 41.32 ES. It'll become very clear why I was looking for a break back over that level. But this was a good example of everything lining up, of having multiple layers of conviction. And that is typically when the best trades tend to come. Now, the last thing that I want to talk about, this ended up being a 30-point trade that I got stopped out on overnight. So my trailing stop finally hit 30 points in profit on runners. The key word there is runners. So every day I look for 10 to 15 points. I look for small chunks, and that's how I try to make my profits. But I look to leave runners in case we get a super strong trend day like we saw yesterday. And important to know, I'm ready to play long or short. I don't have bias. I'm not bull, bear. My main goal, again, is to catch 10 to 15 points in however way I can make that happen. And when we get those super strong trend moves like we got yesterday, I love to have those runners in play so that I can be a part of that move. But those days are extremely rare. We have to remember that. They're very rare. So just coming into the day, being conservative, trying to catch a small portion of the move is how we can stay alive in this game. But hopefully that all makes sense to you guys. And that's going to do it for this morning's show. So we'll be trading again all day today live. We've got 6 of us in the Kane Capital Discord. You can go to kane-capital.com. We appreciate you guys tuning into the show all week. I know we had a short crew today, but we'll be back in full strength come Monday morning at 8:30 a.m. Eastern time, and we will catch you guys then. Have a phenomenal day and an even better weekend, everybody. We'll see you later.